So let's look at the income statement. The income statement tracks the earnings or income as well as the expenses of a business over a period of time. So unlike the balance sheet, which is as of a specific date, specific point in time, the income statement is for a period of time. So it might be for a month or a quarter or a year. It includes revenues and expenses in itemized categories. So what does the income statement tell us? Well, it tells us the profitability of a business in a nutshell. It tells us the gross sales of an enterprise. It tells us the gross margin and overhead, and we'll explain what those terms mean in a minute. It shows spending on various categories of expenses, and ultimately our net income or our profit. So how do we make about an income statement? Well, we start with income. So we start with revenues or gross sales, grant receipts are income, and government payments are income. So basically any income that you earn or that comes into the business. However, proceeds from a loan are not income because you didn't earn that money. You have to pay it back. So if you borrow $100,000, that's not income. But if you get a grant for $100,000, that is, or if you make a sale for $100,000 or sales for that amount, that would be income. So from income, we subtract expenses, which include things like supplies, feed, payroll, overhead. Basically, it includes all the things that go into your product or service that you're making, as well as things like what we call overhead, which is the kind of expenses you need to open the door and turn the lights on. Those are things like property tax, office expenses, advertising, marketing, professional services like tax prep, those sorts of things. So your income minus your expenses is your net income, or what's sometimes referred to as profit or net earnings. So let's look at an example of an income statement. Well, first, before we do that, let's define some terms. So cost of goods sold, I mentioned that term earlier, or variable expenses, is basically the cost of components that create the final product for sale. In other words, one more plant or animal or gallon of milk or what have you. So these include things like production labor, seeds, fertilizer, feed for animals, supplies, basically anything that goes into our plants or animals. So let's go back to our example of Chris's greenhouses. So Chris grows hanging baskets. So what are his cost of goods sold going to be? Well, they would include things like the basket itself, the pot. They would include the growing media, the seedlings, the seedling plugs that he goes to plant in the hanging basket. It would include the production labor to put it together, to water it. It would include the fertilizer. Basically all the components that go into that product to make one more unit of output, if you want to use those terms. Everything that goes into that is referred to as a variable expense or a cost of goods sold. And sometimes that goes by the acronym COGS. So in contrast to that, well, let's go into those example line items a little bit more. For a vegetable grower, it would include the production labor, seeds, starter plants, fertilizer, boxes or packaging, selling and shipping labor, basically all those inputs. So in contrast, fixed costs, sometimes referred to as overhead, are those costs that remain the same regardless of variations in production. So these are costs that don't usually change within a season, or when they do change, they tend to change in steps as your business grows and expands. So these are typically things like office expenses, property taxes, interest on loans, depreciation, which is the rate at which your equipment loses value, marketing or advertising, rent or lease of land or facilities. Going back to Chris's greenhouse expenses, overhead would include things like interest on a loan if you had to borrow money for the facilities and equipment. It would include various things like that, the office expenses to account for all the revenue and expenses of the business. So those are fixed costs. And the reason they're referred to that way is because they behave differently. So if Chris decides to add another 100 hanging baskets to his output, his variable costs are going to go up by 100 units. He's going to have to buy 100 more pots, 100 more hanging baskets, 100 more sets of plugs, more growing media, more labor. But things like the office expenses and the advertising, that's not really going to change. If he increases or decreases his production, for that matter, those costs stay the same. So that's typically why we itemize those separately, because they behave differently as your business grows and expands and conducts its operations. So a note about loan payments here, because they require some special treatment. Loan payments consist of two components. So you have interest. This is an expense on the income statement. And then you have principal, and this is the repayment of the loan amount. And that is not an expense on the income statement because you didn't earn it when you got the money, so it's not expensed when you pay it back. It's a different transaction. It's not part of your operations of your business. It's part of the financing activity of your business. So let's take a loan payment example. Let's say you have a mortgage on your farm and you pay $1,500 a month for that mortgage. You may find that, particularly in the early years of your mortgage, you're paying more in interest than you are in principal. So $1,000 of that $1,500 might be interest. That $1,000 would be an expense on your income statement for that month. The $500 that goes to principal would not be a expense on the income statement. However, foreshadowing to the cash flow statement, and this is like one reason why we do both an income statement and a cash flow statement, because this is where they start to differ a little bit. You would include the full amount of that loan payment on the cash flow statement because you have to write a check for that. And you want to make sure you don't run out of cash. So even though it's not a deductible expense on the income statement or for tax purposes, the principal payment, you want to factor that in your cash flow because you do have to write a check for it. So that is a little bit of a complicated concept, but we'll discuss a little bit more about it when we get to the cash flow statement. So depreciation is another kind of special expense line item because it's a calculated expense and it's a non-cash expense. So let's talk about what that means. So depreciation is the rate at which your equipment loses value. So if you bought a car for $20,000 and that car has an expected life of 7 years, or it could be a tractor or any piece of equipment, a furnace for your greenhouse. So if the initial investment is $20,000 and the expected life is 7 years, that's going to depreciate roughly $3,000 a year, a little bit less, $2,857. So and the reason for that is because this is for equipment that's going to last more than 1 year. So if you bought that $20,000 tractor, it's not really fair to charge that whole $20,000 against your business income the first year because that tractor is going to outlast 1 year or better. So to justify it, you really want to only expense the rate at which it wears out. So if that has a 7-year life, you want to take 1/7 of that amount each year and expense that amount. So you don't write a check for it. It's the rate at which your equipment loses value or wears out. But you should account for it because if you don't, then you're not going to have the earnings available to replace that piece of equipment when it comes due. And also, it's an important tax deduction as well on your income statement. So depreciation is a is, like I said, it's a calculated expense, but it's something that is important to calculate and factor in on your income statement. So let's look at a very simplified income statement. We call this a 5-line income statement. So here we have income, we have COGS, cost of goods sold. We have the income minus the COGS equals gross margin. And gross margin is what's referred to as, or what that means is it's the money that is left after your operating expenses. And then from that, you take fixed costs, and the result of that is profit or net income. So in this case, for this example, Chris's greenhouse, we have revenue of $134,400. The cost of goods sold were $80,096. That left us with a gross margin of $54,304. And that gross margin is what's available for overhead recovery and net income. So our overhead in this case, and the owner draw is included in the overhead in this example, came to $40,345. And then the profit or the net income was just under $14,000, or roughly 10% of total revenue. We can see the percent of sales on the right column. So we start off with 100% because by definition, the income is 100% of sales. Cost of goods sold came to 60% of sales. So that means that for every dollar we sold of product, 60 cents of that dollar went to produce that product. That left us with a margin of 40 cents or 40%. And then 30% of that went to overhead, our office expenses, our owner draw, our advertising, our depreciation. And then that left us with a net profit of about 10%. And these percents are fairly typical of a lot of farms. So one of the points of this exercise here, this slide, is to just kind of show how quickly the money goes, because $134,000 in revenue sounds like a lot, but the money goes quick. So that leaves us only with $14,000 from which to pay our debt principal payments, as well as to reinvest in the business. So those are two pretty important functions that we need to account for. So that's the 5-line income statement. Here is a more in-depth income statement. And so again, we're getting back to Chris's greenhouse. So we have plant and produce sales. He grows hanging baskets, bedding plants, and some vegetables in his hoop house. So we have let's say $75,000 in plant and produce sales. At the beginning of the season, he sold some CSA shares, $5,000 worth. So that gives us total income of $80.59. And then we have those cost of goods sold. So we have the pots, the soil mix, the fuel for the greenhouse, the fertilizer, chemicals, supplies, labor, you name it. So that's total cost of goods sold of $40,834, just over half of revenue. That leaves us with a gross margin of $39,225. Then we have depreciation, interest, repairs and maintenance, property taxes, insurance. These are all fixed expenses because they don't directly go into the product. Utilities, advertising, professional fees, office supplies, etc. That came to $42,285. So, but you'll notice the gross margin that we had to cover overhead was only $39,225. So what does that mean? Well, that means we had a small loss. We lost $3,060 last year. So, that's unfortunate. In real terms, what does that mean? Does that mean that, Chris's greenhouse is bankrupt? Well, and notice that there's the biggest line item for depreciation for expenses was depreciation. That was the rate at which his tractors and his delivery truck was wearing out. And we didn't write a check for that. So that was a non-cash expense. So really, Chris's greenhouse, if we take out depreciation, he had about $10,000 worth of positive cash flow. But on paper, when you factor in depreciation, he lost money. So, in the banking world, we call this living off depreciation, meaning that this farm is surviving because they're not really covering their depreciation. And that works for a short-term scenario, but longer term, that equipment's going to wear out and need to be replaced. And if we're not covering depreciation in our earnings, we're going to struggle to replace that equipment. So that's something that's important to factor in long term. But that's an analysis of this income statement. So we can see that one of the things also that to note is that the income statement, the schedule of accounts, it's called, or the line items used, are going to vary substantially by industry sector that you have. So these accounts, pot, soil mix, fertilizer, seeds and plants, all that stuff, that makes sense for a greenhouse. If you're a dairy farm, for example, you would have a very different schedule of accounts. You would have things like animal feed, livestock replacements, other, supplies for your milking. You'd have other line items in there. So when you're doing an income statement, you want to make a schedule of accounts or line items that make sense to you in various subcategories. So you want them to be specific enough that you know what the money goes towards, but inclusive enough that you don't have a million line items and your balance sheet becomes overly cumbersome. So as a rule of thumb, it's good to come up with, a dozen, 15 line items that make sense for your business and use those for your accounting purposes. So how to use the income statement to manage profitability? Well, first of all, let's back up a little bit and talk about why profits are important, period. And we mentioned this already, but the debt principal payments have to come out of profits, business reinvestment, as well as owner income. Now, for accounting purposes, you could account for your owner draw, paying yourself essentially, either as a expense on the income statement, or you could take your salary out of the net profits of the enterprise. Either way works, but you should be consistent in how you account for it. You can also use your income statement to manage profitability by managing from records. So the income statement can show where the money comes from and where it's spent. And so going back to Chris's greenhouse again here, until the income statement was really put together and examined, Chris may not have known that he actually lost money last year because he cash flowed $10,000 plus as a result of his operations. But when we factor in all the costs that were involved, we see that it really came out negative. So that kind of accounting and record keeping is really important to managing a business successfully and sustainably over time. So we're going to move on next to the cash flow statement. So please join us for the next section.